really tough to make a video when you have kids running around the house. It's very tough. Anywho, so today I want to talk about dollar cost averaging. What is dollar cost averaging? And why do you care, right? So, dollar cost averaging is basically a strategy to remove the guesswork of when should I put my money in the market. Because a lot of people are like, oh, I want to invest, but I don't know when to put my money in. And it's like, hold on, hey, pause. Right? We can't time the market because we just can't do it. We don't have a crystal ball. We don't know when the next pandemic is going to come, right? So a few months ago, everybody was a genius, right? I can show you how to make $100,000 in the market. Just follow me. Yeah, it's great when everything's going up, when the economy is booming, the market, jobs are strong, everything is great, right? But guess what? No one thought about a pandemic, right? Which brought the market crashing down and a lot of people to their knees, right? And it's like, where's your genius at now? And that's the thing. There's no way of predicting these things. So you have to build in unpredictability or unpredictability. Is unpredictability a word? Unpredictability, right? So I was watching this show called The Money Guys, and it had a great example of dollar cost averaging versus lump sum investing. So I'm gonna put up a screen that has the graph, and I'm gonna go over kind of what happened in it. So we look at this example. We're gonna use two investors. We're gonna use investor A, which puts $260,000 in at the very beginning, purchased at $381, and ends at $383 over the course of 25 years. Now, in real life, you're like, no one's going to leave their money in for 25 years and not pull it out once they see the market crash. But this is just an example. And it has happened. So let's just use it to just show a stark difference between dollar cost averaging and lump sum investing potentially, right? So investor B does something a little differently. So instead of putting the whole $260,000 in initially, what he does is he puts it in at $10,000 increments every year consistently over the 25 years. So along the way, investor B also makes an average of 11.7% return on his money. And we're going to use dividends as what's used to give that 11.7%. So the company pays out a percentage of the profits based off the amount of shares a shareholder has, which in this example is going to generate an extra $1,170 a year. So that money is then going to be used the next year to purchase more shares. And those shares are going to receive dividends as well. And so this will show how the compound effect really starts to take place. And in this example, over this 25-year period, investor B grows his money to become $1.5 million at the same time that investor A only makes $2. So this shows that dollar cost averaging could really help in times where the market starts to crash. So if you're a new investor or if you just don't have a high risk tolerance, dollar cost averaging could be the way for you. So if you ask the question, when should I invest, which a lot of people ask, the answer is right now, consistently, over time. So this concludes my video about dollar cost averaging. I want to make a note that dollar cost averaging isn't necessarily going to make you more money always over the long term versus lump sum investing. But it's just a good tool to use for beginners and people who don't have a lot of risk tolerance and don't want to deal with all the emotional effects of the market. Thank you for watching. My name is Jamario Kelly, and I will continue to do videos like this, investing for beginners. I also invest in real estate. That's something I've really been doing, and I have a lot of great stories about that, a lot of mess ups. So I like to share that with a lot of people, and just teach people, like, in general, how to get started, how much money you might need for flips, rental investing, even horror stories with that. So if you like what I'm doing, please give me a like, subscribe. I mean, that would be great. And hey, you have a good day.